All right, today we're going to dive deep into GB Financial Holdings' latest Q4 earnings. Now, on the earnings call, management painted a picture of a company getting its house in order. But the market? Well, the market wasn't buying it, and the stock took a hit. So, let's get into the why. So that's the big question here, isn't it? Management kept calling Q4 a fix the plumbing quarter. A time to focus on the boring but necessary stuff, internal controls, profitability. Sounds pretty responsible, right? So why on earth did the stock tank? And you can see that disconnect plain as day right here. On one hand, management's message was all about strong execution, record revenue, things are great. But the market clearly heard something completely different, and bam, the stock gets pushed down over 4% the very next day. Let's unpack what's going on. Okay, first things first, let's look at the actual headline numbers. Did the report itself justify such a negative reaction? Well, what we're looking at here is a pretty slight miss on the bottom line. GAAP earnings per share came in at 51 cents, just a single penny shy of what analysts were expecting. And revenue? That was right in line with expectations. So a tiny miss on earnings, but honestly, on its own, that is nowhere near enough to explain the drop. There's clearly more to this story. And this chart really puts the market's concern into context. You can see that even before these earnings came out, the stock was already lagging its peers. Over the last month, GBFH dropped almost 2%, while the regional banking ETF, that's KRE, was up almost 5%. So the earnings call seems to have just thrown gasoline on an already smoldering fire of underperformance. To really understand the stock's drop, we have to dig into management's story. And let's start with the biggest piece of the puzzle, the strategic reset in their super high-growth credit card business. This timeline basically tells the whole story, like a mini soap opera. In Q2, they were seeing this explosive, incredible growth. But that growth attracted a massive wave of fraud in Q3. And it got so bad they had to completely shut down all new applications. So Q4 was all about the rebuild, putting in a new, tougher, know-your-customer system to stop the bleeding. And now management is adamant that these new controls are holding strong. And you really can't overstate the confidence coming from the CEO on this. I mean, Ed Negro was emphatic, saying not one fraud has gotten through in the last 60 days. Wow, that is an incredibly bold, definitive claim. And it's really the foundation of their entire turnaround story for this business. But of course, slamming on the brakes that hard, it comes at a cost. Transaction volume took a huge hit, falling to just under $100 million. Now, management argues this wasn't some kind of failure, but actually an intentional, controlled decline, a necessary evil to secure the platform for the long run. And this theme of prioritizing stability over just raw, unchecked growth also popped up in the second big part of the call, their SBA lending unit. Here again, the story was all about focusing on margin over volume. Okay, and a key term you gotta know here is gain on sale margin. It's pretty simple, really. It's the profit the bank makes when it sells the government-guaranteed piece of an SBA loan to investors on the secondary market. For a bank like GB Financial, this is a really critical driver of their income. And on this front, their strategy was a clear home run. The company managed to boost its gain on sale margin to nearly 4%, which is a really healthy jump from the quarter before. By just being more disciplined, they're now making a lot more profit on each and every loan they sell. Management also added some important context. They noted that the overall number of new SBA loans was held back by the federal government shutdown late last year. Apparently, that just gummed up the works for the entire industry and helps explain why their total revenue from loan sales wasn't even higher, despite those much better margins. So, that's the story of Q4. You had the credit card cleanup and the SBA margin focus. But what does it all mean for the future? As an investor, that's what we really care about. So here's our take on what to watch for next quarter. For us, we're watching 3 absolutely critical things. First, and this is the big one, can they prove the credit card business can actually start growing again now that the new fraud controls are in place? That's everything. Second, we need to see those SBA loan originations bounce back now that the government shutdown is behind us. And third, they have to keep up that new discipline on costs and margins. Okay, so putting it all together, here is our official forecast. We're rating GB Financial Holdings a market perform. Frankly, we think the stock to be stuck in a rut range-bound until management provides hard proof that the credit card engine can be safely restarted. For next quarter, we're actually forecasting a modest beat, but we think it'll be driven by that continued strength in SBA margins, not a big recovery in growth.
And finally, let's talk strategy. Based on all of this analysis, we've cooked up what we're calling an outrageous but plausible trade idea for how you could play this situation. So the setup is a classic pairs trade. On one side, you go long GB Financial Holdings. This is your bet on their specific company-centric turnaround story. The thesis is simple. Management fixed the fraud problem, and their SBA margins are getting better. At the very same time, you short the KRE, that regional banking ETF. This acts as a hedge, basically neutralizing your exposure to risks that affect the whole sector, like interest rate moves or credit worries. It's a trade specifically designed to isolate the potential upside from GBFH just executing on their plan. And of course, our final mandatory reminder, this is not financial advice. Every investment strategy involves the risk of loss, so please do your own research.